Welcome to Oxen Group webinars. This is our second webinar of our new webinar series for our premium members. Today's webinar is actually going to be featured for non-premium members and other members, simply just to help people know what we're doing with webinars and to see them. For a limited time, it'll be available to everyone, and then after that will be exclusively only available to premium members. So basically what we want to talk about today is how can you use the technical indicator RSI to invest. We're going to be talking about what it is, some of the basics, some of the examples, and how we use RSI. So what is RSI? Well, basically RSI is a technical indicator that is used to determine if a stock is overbought or if it's oversold. And from that we can then decide whether or not a stock would increase or decrease from those levels. And basically the indicator is configured by taking a comparison of recent gains with recent losses, and the formula for RSI is 100 minus 100 divided by 1 plus RS. And what that means is basically you're going to take, these are the 100 days, and in the last 100 days, what if the average number of days it's closed up divided by the average numbers of days it's closed down, and that will give you a relative strength. And this will give you the RSI. So the RSI indicator, you can see here, this is a technical indicator, and it moves from 0 up to 100. Okay, and so when you have the two main lines that show where the stock is heavily overbought or heavily oversold, okay, with 50 being in between, being the exact middle, the stock's not overbought or not oversold. When the stock moves above 70, it shows that the stock is oversold and it should be due for a pullback. This is because the stock has moved up quite significantly in price over the last 100 days, and that investors are more likely to take profits at these levels, given that there will be less buyers at these levels and more sellers. As the stock moves down to 30, it shows that the stock is very oversold. Okay, there's been a lot of selling off, and there'll probably be very few sellers left that want to sell the stock and make it go even lower, and so a lot of buyers will move into the stock. And as we can see here, this makes sense. This works perfectly. When Trina Solar broke 70 here on January 12th, it appears that the stock was here and started to trend back down. And then as it broke 70 again up here, it was a great short sell once again as it moved back down. Now the stock bounces across the 50 line and hasn't moved back down to 30, and it moves up and down even if it hasn't hit 30 or 70. However, you can tend to bank on the fact that when the stock is right around the 70 level, this is a good time to short sell a stock in association with other indicators. So using RSI alone without anything else tends to not make sense, except for several occasions with more midterm trades and swing trades, which we'll get into all that a little bit later. But you can see that this indicator can help you in association with something. If you're thinking, well, that stock looks good to move up for the next couple of weeks, okay, well, you have that sort of indication that you think that might occur. Well, you could take a look at the RSI. If you see the RSI is already at 70, the chances that the stock is going to move really well over the next 2 weeks or next 3 weeks is highly unlikely, unless it has somewhat of a little bit of a pullback and then can even push higher, as Trina Solar did. But more likely or not, unless it's below 50 or or closer to 30, that would be a better indicator that the stock has a lot of potential to move to those levels in the next 2 to 3 weeks. So let's take a little bit more at the RSI and look at some more examples. So here's Ford. This is a company that we bought just on Friday for a day trade and made a quick 2% on. And you can see that this stock works just like we thought. Okay, so here this stock bounced right off a 30 level. It hit a bottom and it sold off right from the 70 down to the 30 and bounces back up off it. Here was a great time to sell. Here was a great time to buy. In this area, the stock, you can see though, there are times here and here that a stock will move above 70 and trend higher. And that has a lot to do with just simply that a stock is more likely to move up for a longer period of time than a stock is to move down for a longer period of time, given market sentiment. If the market is in a bullish run, then a stock can push over 70 for quite some time. If the market overall is in a very bear run, we did see a lot during the financial crisis. A lot of stocks registering RSIs down by 10, below that even. But it's more likely that the stock will move above 70 in general market conditions than it would below 30. So a good time to buy is any time really a stock gets below 50, in my opinion, and sell around the 70 area. And that's in the midterm to swing trade time frame. Again, we can look at another company. Here's Apple. You see that this stock hits the 70 level, trends down. But you can see with Apple that the stock rarely moves down very far in the RSI, and this is because of you have to apply RSI to the stock. You can't just use RSI as a simple well, it's at 70, this is the time to sell, or well, it's at 30, this is the time to buy. You have to apply it to what's going on with the stock. And Apple, this is a stock that on any kind of pullback is always bought up. I mean, because everybody loves the stock, everybody wants to own the stock, and everybody thinks it can always go higher. So you see that 50 is much more likely a line where you could buy over time. You can see that historically that's a really good point in which you can buy, and that the stock will push up from that line rather than the 30 line. And so RSI again is something that is great as an indicator, but it's only an indicator, and it has to be used in association with other indicators, which we're going to get into in just a second. So how do we use RSI specifically here at the Oxen Group? Well, here we'll talk about here day trades. Okay, so we do use RSI for day trades. It's not as useful as midterm trades or swing trades, but it is useful when we're looking at a day trade, because here's what happens. When we typically do day trades, we call what we do fundamental day trading. And so we're looking for a fundamental catalyst that can move a stock, okay? So if we have a fundamental catalyst like a really great earnings report, okay, let's say here at Ford, when Ford had this, their RSI was at 70. This date right here is when they reported earnings. If the company had really strong earnings, that beat estimates, that did pretty well, the amount of room for this stock to really increase much more in a short, in a midterm to short-term basis would have been, relatively low. But at the same time, since the stock's earnings were bad and they missed estimates, this was a perfect short sell that you knew even after a drop could even go lower because the RSI was so high, showing that relative strength of the stock recently had been very overbought. So moving into earnings, this stock was overbought, overbought, overbought. So earnings had to be very, very good in order to beat expectations and justify this high RSI level. So therefore, when the earnings were a little bit weaker than expected, the stock dropped tremendously. And that can be used on a single day basis or a midterm to swing trading basis, as we talk about here. It's really useful for swing trading that lasts more than 2 to 3 days, because we want to buy at 30 and then we think over a 1 week or a 2 week period that stock can then increase in price from that level. And here's a perfect example with Yum Brands. Okay, back in the very beginning of February, you see that the stock hit the 30 level. If you had bought there, hit the 30 level on RSI and the stock price was 46.50. Today, it's now at 49.77. And so you can see that this was a great time to buy the stock. They had earnings coming up in the next couple of days, which we're going to get into very specifically just here in a second with using earnings in RSI. So this was a great time to buy. The stock had, hit a bottom. There were no expectations for earnings whatsoever. Even when earnings came out on this date right here, we see that the stock was still, registering a pretty low RSI around the 40 level, and so the ability for a lot of upside was and a lot of potential for upside was there. Whereas if the stock had been at 70 at earnings, even if earnings had been good, you could expect that that it had hit a pretty much a high and probably wasn't going to increase too much greater from that level. And as I said before about short selling at 70 is often positive, but again, short selling does tend to, in the market we're kind of in right now, with a lot of buying and a lot of bullish runs and an overall pretty positive market sentiment, short selling is tougher to do. So with earnings, we kind of touched on this a little bit, but if you're going to use earnings to trade with RSI, you have to either be doing earnings beforehand, like a week before getting into a stock and thinking it can move up or down from that level, and then using RSI also with like an overnight trade or a post earnings trade. So here's two examples. We'll look at Tesla first. This is a stock we just got into at the end of the week, and you can see that the RSI right now is registering about 39.25. Okay, so this is fairly undervalued for this stock, and we can see that over the last month it's hit a 30 once, but it tends to really get a lot of support right at this 40 level, and it's not really. It had this one drop, and then it's gotten support at this 40 level for pretty much the rest of since it hit that high back in the middle of January. And what this is telling me is that the downside risk on this stock is very low because the stock doesn't really register much of a lower RSI, but further that this stock has a lot of potential moving into earnings because it hasn't been overbought and it has the potential to move up and be bought up because there are a lot of buyers on the sidelines on the stock instead of a lot of sellers on the sidelines. So sellers are in the stock or really haven't had a chance to sell, and so this stock has a lot of potential to move up from these levels. We look at the opposite situation with a company, International Flavors and Fragrances, who reported earnings on Thursday. Well, moving into earnings, right before earnings, you see that this stock was registering at the 70 level, above it, and right before earnings, around the 65 level. Okay, so this is a very overvalued stock, all right? And we see that it had earnings. The earnings were not what people had expected, and so the drop is extremely significant in the price, and RSI matches that, dropping all the way down here to below 40. So moving into earnings, if a stock has a really high RSI, it can be dangerous because that could mean that a stock that has a little bit of a disappointing earnings or even earnings that meet consensus estimates, that means that those earnings have probably already been priced in, and if they were priced in and they disappointed, it's even worse than if they just were priced in and they hit consensus. Even if they're priced in and the stock beats, it can tend to still have some of a sell-off as the earnings trade is over and investors want to move on to something else. So that's how we can use RSI with earnings and make money, and that's how we tend to look at RSI when we're approaching some of our midterm trades, some of our earnings trades. That's going to do it for today's webinar. We hope you enjoyed it and learned a little bit more about RSI. Please check us out at www.theoxengroup.com. Email us at any time at contact@theoxengroup.com. Call us at 1-800-709-1160. Be a part of 70% plus accuracy.